Prior to the US's tax cut, high tax countries, mostly OECD members in the European Union, were claiming that low or no tax jurisdictions were engaged in harmful tax competition and were threatening their tax base. Their argument was based mostly on these low or no tax jurisdictions stealing businesses away from the high tax jurisdictions. Of course they were. Why would a business stay in a high tax jurisdiction when there's a low tax alternative? It's just good business to go where taxes are lower. To try and stop this so-called harmful tax competition, high tax countries employed various tactics like shaming and blacklists to try to stop the low or no tax countries from engaging in this harmful tax competition. But let's start with this. There's no such thing as harmful tax competition. There's just tax competition. Second, competition, especially when it comes to taxes, is a good thing. It helps keep greedy governments in check. Trying to force businesses to stay, government should be trying to attract businesses so that businesses don't want to leave and new businesses want to come. Capital is always going to go where it's welcome. My point is, rather than lowering tax rates themselves, high tax countries tried to halt tax competition so they could charge high tax rates. Income U.S. tax reform. At first, the high tax countries, especially in the EU, complained about the U.S.'s tax reform and threatened to take action against the U.S. But what are they going to do to the U.S.? I'll tell you, not a goddamn thing. The U.S. will do whatever it wants, and there's nothing that the OECD or the EU can do about it. And the result? Countries around the world, including those in the OECD and EU, have started lowering their corporate tax rate. The latest country to do so? The Netherlands, lowering their corporate tax rate from 25% to 20.5%. I, for one, am excited about this race to the bottom, and if you're in business, you should be too.